So our next question comes from Angel. Angel says, hello, Robert and Austin. Huge fan of the podcast for educational purposes. What would you recommend me doing with some rental property equity? Current rental loan is $257,000 with a current estimated value of $700,000. The interest rate is 3.375%, and I currently make $1,000 a month in cash flow. I'm 42. I have $39,000 in a high yield savings. My 401k is at $260,000. I stopped maxing out my 401k this year to focus on cash savings and my Roth IRA. I just opened up a Roth IRA this year thanks to you all, and I'll max it out from here on out. My spouse and I make $180,000 a year. I've got one child in college, and I'm helping them pay some tuition, and the only other debt is a primary home property that is $510,000 at a 2.5% interest rate. I've always dreamed of building 1 to 2 ADUs on my current rental property. It has a very large lot, but I've been advised by a financial advisor not to take on the risk. What are your thoughts on how to best utilize the rental equity, and would you consider it a good risk of building 1 to 2 ADUs? Can't wait to hear what you have to say. Robert, I'll let you kick this one off.
Yeah, I love this question. I deal with it all the time. Should I build out more ADUs on property? Should I add more rental units to my portfolio? But one thing I want to say to everyone that's either building a company that has properties that have a lot of equity in them, always understand and ask yourself this question. If I can get my hands on $400,000, $500,000, $1 million right now and invest it properly, what does that do for the rest of my life? What does that do for my retirement? And in this situation for Angel, I would sell the property in a heartbeat. I would put that money in all the right accounts and do all the investments we talk about every single week and every day on this podcast. And I would ride off into the sunset, because then you're guaranteeing yourself to be a millionaire or a multimillionaire by the time you're 60 years old. That's what I would do, because here is the opposite opportunity. Let's say you build the ADUs. It goes okay. They don't cash flow very well. They don't have capital appreciation like the normal house did over the years you've owned it. And then all of a sudden you have all of this extra debt, presumably through a HELOC, which is going to cost you 8%, to be able to build these and then absorb a lot of the equity you already have built. Because remember, you take out this big loan. Let's say each ADU is $80,000, $90,000, $100,000. Well, that loan's coming out of your equity. So then all of a sudden, if it doesn't cash flow like you'd hoped, and it doesn't have the capital appreciation, you're going backwards rather than forwards, because they're never going to cash flow that much. Maybe you get $200, $300 per unit per month, but that's not enough to make up the difference of what $400,000 invested in the markets making 8, 9, 10% a year is going to do for your net worth over time. That's my take.
Yeah, so let's extrapolate upon that. So $700,000 you sell this rental for, you pay off your current loan of $257,000, you pay some closing costs, like whatever. You're all in around $400,000. Let's just say $400,000. On that $400,000, getting an 8.5% return on your money on an annualized basis, that's $34,000 a year. You divide that by 12 months, that's almost $3,000 a month. That is much more than the current $1,000 a month that you're cash flowing, right? And depending on how you invest this, I would imagine that it would even be more tax efficient. If you are investing in NEOS funds and you're looking at that monthly distributions, those are all considered a return of capital, so that's all tax free. Your cash flow, I think right now, is taxed as ordinary income, if I'm not mistaken. And if you do this, you have the long-term capital gains, right? There's a lot of different levers to pull here when you have the money invested in the markets. I think if I were in your shoes, the S&P is up 11.2% so far this year, and the NASDAQ is up like 12 or 13. If I were in your shoes, I would take this $400,000, I'd park it in the markets, I would forget about it, and I'd let it double every 7 years. Fast forward, you're 42 right now. That's $3 million, $3.5 million by the time you're ready to retire, all because you sold this rental property and focused on capital appreciation versus cash flow. Now, sure, the $700,000 may be worth $1.5 million, right, in that period of time, but would you rather have $1.5 million with like some mediocre cash flow, or $3.5 million of actual funds invested? And I'll take the 3.5 any day of the week.
100%. And it always brings me back to a story after Silly Bands when I was sitting on millions of dollars. And my cousin Tim said, give me $5 million right now. So if we put it in context of this question, it's really hard to get your hands on $400,000, $500,000, $1 million, $5 million. And once you do, if you invest it correctly, especially at a younger age, you're set for life. And so many people get it backwards and they just over invest and they take more and more shots and they end up going back financially. And I don't want to see them do that.